You may not be losing because your read on direction is poor. You may be losing because you are entering one phase of the market with the expectations of another. That is an uncomfortable mistake because it does not feel reckless when you are making it. You see a clean move, you recognize a familiar pattern, you remember how well it worked last week, and you act. But the market has changed its behavior quietly. The same entry that once rewarded decisiveness now punishes it. The same patience that once protected you now leaves you behind. Nothing obvious is broken, yet your results begin to bend against you. This is where many traders begin forcing answers from the chart. They call it bad discipline. They call it hesitation. They call it revenge trading. Sometimes it is. But often the deeper problem is simpler and more dangerous. They have not recognized the trading phase they are in. A market does not move with one character forever. It expands, contracts, trends, stalls, shakes out, absorbs, and distributes. Each phase invites a different kind of mistake. In a strong directional phase, waiting for perfect comfort can cost you the move. In a choppy phase, chasing strength can place you directly into the hands of better, positioned traders. In a breakout phase, fear of false moves keeps you late. In a false breakout phase, confidence becomes the trap. The trader who cannot tell the difference starts treating every condition as if it owes him the same response. He buys strength because strength worked before. He fades extremes because fading extremes worked before. He tightens stops because recent losses made him cautious, or widens them because he is tired of being shaken out. Each adjustment seems reasonable in isolation. But if it does not match the market phase, it becomes just another refined way to lose money. So the first work is not prediction, it is recognition. Before you ask where price should go, ask what kind of behavior is in front of you. Is price accepting higher levels or merely reaching for liquidity? Are pullbacks being bought quickly, or are they growing heavier with each attempt? Are breakouts holding, or are they attracting late traders only to reverse against them? The answers are rarely found in one candle. They appear in repetition, response, and failure. This is why phase breaks are so costly. They do not announce themselves with ceremony. They reveal themselves through small contradictions, a setup that should follow through, but does not, a level that should reject price, but begins to accept it, a move that looks powerful but leaves no continuation behind. The market can change its character before you are willing to change your opinion of it. That is where the damage begins, not in the chart itself, but in the small delay between what the market is doing now and what you still believe it should be doing. You come from a clean run of trades. The movement has been clear. Pullbacks have held. Breakouts have followed through. Your mind begins to call this normal. Then one day, the same behavior does not receive the same reward. At first, you do not see a phase break. You see inconvenience. A trade hesitates, a level reacts differently. Price does not move as freely as it did before. But because the last condition gave you confidence, you carry that confidence forward without asking whether it still belongs there. This is not foolishness. It is human nature. The mind builds comfort from repetition. When something has worked several times, it begins to feel less like a condition and more like a truth. But the market does not owe continuity to your memory. A trader often suffers because he wants the present market to confirm the last market. If the last phase rewarded patience, he keeps waiting even when speed has returned. If the last phase rewarded aggression, he keeps pressing even when the market has become defensive. If the last phase rewarded fading extremes, he keeps fading until a real directional move runs over him. The pain comes from using yesterday's emotional certainty as today's guide. This is why phase breaks are so hard on the trader's mind. They do not only challenge his method, they challenge his identity. When you have been reading the market well, you begin to trust not just your process, but your feeling of being in sync. Then the market changes, and that feeling remains for a while after the evidence has weakened. That delay is expensive. It makes you defend old confidence instead of studying new behavior. Ask yourself carefully, are you trading what is in front of you, or are you trading the market that recently made you feel competent? This question matters because the mind does not release a profitable phase easily. It wants one more example, one more confirmation, one more trade to prove the old condition is still alive. So a trader begins to excuse evidence. A failed move becomes just noise. A weak reaction becomes still early. A poor trade becomes bad timing. Each excuse protects the old belief for a little longer, but protection of belief often becomes damage to capital. The market gives signs when its character is changing, but those signs are rarely comfortable. They appear as contradiction. What should work stops working cleanly. What should fail begins to hold. Price begins to act differently around the same areas that once gave easy answers. If you are emotionally tied to the old phase, contradiction feels like irritation. If you are disciplined, contradiction becomes information. That is the psychological turn. You must learn to separate familiarity from truth. Familiarity says, I know this market. Truth says, this market may no longer be the same. Familiarity wants action because action restores the feeling of control. Truth can stand still and observe. When you cannot make that separation, every phase break becomes personal. You feel betrayed by price, when in reality price has simply moved on. The practical work is quiet. Before you increase size, before you trust the next familiar setup, before you assume the same rhythm is still present, look for emotional lag. Notice whether you are explaining away too much. Notice whether your confidence is coming from current evidence or from recent reward. Notice whether you feel annoyed that the market is not behaving properly. That annoyance is often the first confession that your mind has not adjusted. A trader does not need to predict every phase change in advance, but he must stop arguing with the evidence once the evidence begins to change. The sooner you release the need for continuity, the sooner you can see the market as it is becoming, not as it was. And once you begin to see that shift, the next question is no longer only what you believe about the market. It becomes how your actual execution must change when the old rhythm no longer pays. A setup is not the trade. A setup is only the shape of an opportunity. The trade begins when you decide how that shape must be handled under the conditions in front of you. This is where execution breaks down. A trader sees the same pattern he has seen many times before, and he assumes the same action is required. Buy the break, sell the rejection, enter on the pullback, take the signal. But a pattern does not live in isolation. It lives inside a phase of movement, and that phase changes what the pattern means. In a market that is expanding cleanly, hesitation can be costly. Price does not wait for comfort. Pullbacks may be shallow. Breakouts may move before the cautious trader receives every confirmation he wants. In that phase, execution must be prepared, direct, and free from unnecessary negotiation. The trader who delays because he wants the chart to become obvious often enters only after the advantage has already been spent. But in a market that is rotating or trapping late buyers and sellers, that same decisiveness can become a weakness. A clean break may not be a beginning. It may be bait. A fast move may not be strength. It may be exhaustion. If you execute every breakout as though the market is in expansion, you will repeatedly buy into supply or sell into demand. The error is not that you took action. The error is that your action belonged to another phase. This is why execution cannot be judged only by whether you followed your signal. A trader can follow a signal perfectly and still execute poorly if the timing, confirmation, speed, and commitment do not fit the environment. Discipline is not pressing the button the same way every time. Discipline is knowing what kind of action the current market deserves. You must ask a practical question before entry. Does this phase reward early action, or does it punish it? When price is accepting new ground and follow through is reliable, waiting for too much proof often means paying a worse price. You reduce doubt, but you also reduce reward. The market charges you for certainty. In that condition, the skilled trader prepares before the trigger arrives because he knows that delay will turn a good idea into a late trade. When price is failing to hold new ground, the opposite is true. Certainty is not the enemy, speed is. The trader who enters too quickly gives the market his position before the market has proven it can carry him. In that condition, confirmation is not cowardice. It is a cost of survival. You accept that you may miss some moves because avoiding poor movement is more important than catching every flash of activity. Execution also changes in how you treat failed entries. In a clean directional phase, a small shake may still be part of the move. In a broken or uncertain phase, the same shake may be the warning. If you cannot tell the difference, you will either abandon strong trades too soon or defend weak trades too long. The entry is only one decision, but the phase determines how much trust the decision deserves after price responds. This is the practical meaning of phase-based execution. You do not marry one style of entry. You do not worship aggression. You do not worship confirmation. You choose the behavior that matches the market's current character. Aggression in the wrong phase is recklessness. Patience in the wrong phase is hesitation dressed as wisdom. So before the next trade, slow the process down just enough to name the condition. Is the market rewarding initiative, or is it punishing initiative? Are traders being paid for acting early, or are they being punished for believing too quickly? That distinction changes how you enter, where you enter, and how much proof you require. And once execution begins to adjust to the phase, another question appears beneath it. What happens to the numbers of your strategy when the market stops, rewarding the environment it was built for? A trading method can begin losing money before it looks broken. That is what makes a phase break so deceptive. You may still be taking the same signals. You may still be entering with discipline. You may still be following the plan as it was written, but beneath the surface, the arithmetic has changed. The market has stopped paying the same price for the same idea. Every strategy depends on a certain balance between wins, losses, size of wins, size of losses, and how often real opportunity appears. When the market phase suits the method, these numbers support one another. The wins come often enough. The losses stay within reason. The larger trades appear often enough to pay for the smaller failures. The trader feels that the system has strength because the numbers are quietly working in his favor. But when the phase changes, the numbers usually weaken before the trader admits anything is wrong. A strategy that once won 6 times out of 10 may now win 4 times out of 10. A method that once produced clean winners may now produce smaller wins because price stops carrying far enough. Losses that were once quick and contained may begin to cluster. Nothing dramatic has to happen. A small change in several numbers is enough to turn a sound method into a draining one. This is why a trader can feel confused while doing the right things. The problem is not always a lack of discipline. Sometimes the problem is that the edge is being asked to perform in conditions that no longer feed it. A trend method needs movement beyond the entry. A reversal method needs overextension and reaction. A range method needs respect for boundaries. When the phase no longer provides the behavior the method requires, expectancy begins to decay. Expectancy is not a feeling. It is the average result of a method over a series of trades. If the average win becomes smaller, the method weakens. If the average loss becomes larger, the method weakens. If losing trades become more frequent, the method weakens. If valid opportunities become rare and the trader keeps forcing participation, the method weakens further. These changes do not require one catastrophic mistake. They compound quietly through ordinary trades. This is where many traders misread the damage. They look at 3 or 4 losses and call it bad luck. Sometimes it is. No method avoids normal drawdown. But there is a difference between normal fluctuation and changed expectancy. Normal fluctuation still resembles the system's known behavior. Changed expectancy feels like the same rules are producing a different quality of result. The trades may not simply lose, they lose in a way that no longer matches the old profile. You must learn to watch the numbers without panic and without pride. Not every losing streak deserves a change, but every change in performance deserves attention. Are your winners becoming smaller, even when the entries are reasonable? Are losses arriving in tighter clusters than usual? Are trades reaching partial profit and then failing to continue? Are you getting fewer clean opportunities but taking the same number of trades anyway? These are mathematical warnings, not emotional insults. The market does not need to defeat your confidence directly. It only needs to reduce your edge by a small amount and let repetition do the rest. A trader who does not measure this will keep fighting for the old average result in a new environment. He will assume that enough discipline will bring the numbers back, but discipline cannot force expectancy where the market is not offering it. This does not mean a trader should abandon a method at the first sign of pressure. It means he must know what the method is supposed to look like when it is healthy. Without that reference, he cannot tell whether he is inside normal variance or inside a phase that has stopped rewarding him. A trader who does not know his numbers is left to judge by mood, and mood is a poor accountant. So study the method as a business, not as a belief. Know the usual win rate. Know the normal size of a winner. Know how often losses tend to come together. Know what conditions produce the best trades and what conditions make the same trades thin and unreliable. When those numbers begin to shift, the market is telling you something practical. Price usually changes its behavior before traders change their story. That is why a phase break is rarely seen by the crowd at the moment it begins. The market does not need to make a grand announcement. It only needs to stop behaving the way it behaved before. A level that once rejected price cleanly begins to absorb it. A breakout that once ran freely now stalls. A pullback that once brought confident buyers now produces weak response. The surface may look familiar, but the character underneath has started to shift. Market structure is not only about lines on a chart. It is about response. When price reaches an area, what happens next? Does it leave quickly, or does it spend time there? Does volume and participation create continuation, or does the move fade after attracting attention? Does a failed move reverse with force, or does it merely pause before trying again? The answer is not in the level alone. It is in how price behaves around the level. A trader who watches structure properly is not trying to predict every turn. He is studying evidence. If price repeatedly pushes higher but cannot hold higher ground, that is information. If sellers strike a market and price refuses to break down, that is information. If a range grows tighter after a large move, that is information. The market is showing whether participation is expanding, weakening, absorbing, or hesitating. This matters because every phase has its own footprint. A healthy directional phase tends to reward continuation. Pullbacks are contained. Breaks hold. Failed counter moves are quickly corrected. A rotational phase behaves differently. It stretches in both directions, draws traders in, then returns toward the middle. A distribution phase may still print strength, but that strength begins to lose result. Price can rise, yet each rise carries less conviction. An accumulation phase may look dull, but weakness begins to fail. The untrained trader sees movement. The trained trader studies consequence. A strong candle is not automatically strength. What matters is what follows it. If a wide move breaks a level and then cannot continue, the move may have spent its force attracting late participation. If a rejection appears sharp but price returns to the same area quickly, the rejection may not be true refusal. If a support level breaks and price cannot stay below it, the break may have served only to test who was forced out. Structure becomes useful when you judge action by its result. This is where traders get trapped by appearances. They see price break a prior high and assume expansion has begun. They see price reject a level and assume the level is still powerful. They see a fast drop and assume sellers are in control. But market behavior is not proven by the first move. It is proven by the market's ability to continue, hold, or recover after that move. Without this second layer, the trader reacts to noise with the confidence of analysis. To read phase change, watch what should happen but does not. In a true trend, a breakout should not immediately collapse. In a strong reversal, the first reaction should not be completely absorbed without progress. In a clean range, extremes should still matter. When these expectations begin to fail repeatedly, the market is not giving random inconvenience. It is showing that the old structure is losing authority. You should also watch where traders are likely to be trapped. When price breaks a visible level and fails, those who entered late are forced to decide quickly. Their exit can fuel the opposite move. When price returns to a level that should have rejected it and begins to hold there, those who trusted the old boundary begin to lose control. Phase breaks often begin at these uncomfortable places, because that is where old belief meets new behavior. The practical discipline is to observe response before naming the phase too confidently. Do not call every breakout a trend. Do not call every pause a range. Do not call every failure a reversal. Watch whether price accepts or rejects new territory. Watch whether reactions are getting stronger or weaker. Watch whether the market is rewarding follow through or punishing it. The structure will speak, but only if you stop demanding that it confirm your first impression. And once you can see the market's behavior changing in the structure itself, the next question becomes sharper. Before you take the next signal, should this market be traded by your strategy at all? The first decision in trading is not whether to buy or sell. The first decision is whether the market in front of you deserves your strategy at all. This is a quieter decision, and because it is quiet, traders often skip it. They open the chart and immediately begin searching for a trade. They look for a signal, a level, a reaction, a place to act. But when the mind begins with action, it narrows too soon. It starts asking, where is the entry? Before asking the more important question, is this the kind of market where my edge should be active? That order matters. A trader who looks for entries first will usually find something that resembles opportunity. Markets are generous with shapes. There is always a candle that looks meaningful, a line that can be drawn, a prior high or low that can be used as justification. But a possible trade is not the same as a qualified trade. The difference is judgment. Decision-making breaks when every market condition is treated as available. If your method performs best when price moves cleanly, then a dull, tangled market does not become attractive simply because a setup appears inside it. If your method depends on reaction from clear boundaries, then a market that is slicing through levels without respect is not offering the same quality of decision. The setup may be present, but the conditions may be absent. This is where the trader must learn to reject before he selects. Rejection is not hesitation, it is control. When you reject a poor environment, you are not predicting that no trade can work. You are saying that this market does not offer the conditions required for your best decisions. That distinction is important. A trade can win and still be a poor decision if it was taken outside the conditions that give your method reason. The market tempts traders by allowing bad decisions to pay from time to time. That is one of its most expensive lessons. A trader enters in a poor phase, gets rewarded, and begins to believe his judgment was sound. But if the decision was made without proper conditions, the prophet teaches the wrong lesson. Then, when the same decision later fails, he calls it inconsistency in the market, when the inconsistency began in his own selection process. Before you consider direction, force the market to qualify itself. Is there enough movement for the method you intend to use? Is price behavior clear enough to make the decision clean? Is the signal occurring in a place where traders are likely to commit, or is it forming in the middle of confusion? Are you choosing the trade because the market is offering alignment, or because you feel the need to participate? This is not a call to be timid. It is a call to be selective. Selectivity is one of the highest forms of aggression because it preserves attention and capital for moments that deserve both. The impatient trader thinks sitting out is lost opportunity. The serious trader understands that sitting out is often the decision that protects the next valid trade from being emotionally contaminated by the last unnecessary one. The cause and effect is simple. When you trade markets that do not suit your strategy, your decisions become harder. When decisions become harder, you start adding opinions. When opinions multiply, discipline weakens. You begin adjusting, explaining, forcing, and negotiating. The trade becomes less about the method and more about your desire to make something happen. A clean decision has a different feel. It does not require excessive argument. The market condition, the setup, and the purpose of the trade point in the same direction. There is still risk. There is still uncertainty. But there is not confusion masquerading as opportunity. The serious trader does not need certainty. He needs alignment. So make the market pass a test before you give it your money. Not a complicated test, a practical one. Does this phase support the behavior my strategy needs? Is this signal appearing in the right kind of condition? Would I still respect this trade if I had not been waiting all day to take one? If the answer is weak, the decision is already speaking. A trader who does not record market conditions is forced to trade from memory. Memory is useful, but it is not a professional tool by itself. It remembers what hurt. It remembers what paid. It remembers the trades that were loud enough to leave an impression. But the market often changes through small details, and small details disappear when they are not written down. By the time the change becomes obvious, the trader has already paid for information he could have been collecting calmly. Professional habit begins before the trade. It begins with a daily reading of conditions. Not prediction, not opinion. Reading. How wide is price moving compared with recent sessions? Are moves extending, or are they stopping short? Are breaks holding, or returning back inside prior areas? Are pullbacks shallow, deep, fast, slow, clean, or overlapping? These observations may look simple, but repeated over time, they create a map of behavior. The amateur watches the market as if each session is separate. The professional watches for continuity and change. One day of poor follow-through may mean little. 3 or 4 sessions where every push fails to travel tells a different story. One failed level may be noise. Repeated failure at obvious levels begins to show that the market is changing how it treats participation. The habit is not to overreact to one event, but to notice when events begin to rhyme. This is why tracking conditions is different from journaling feelings. Feelings may explain how you behaved, but conditions explain what the market was offering. If your record only says you were impatient, confident, fearful, or disciplined, you still may not know whether the market itself was clean, thin, rotational, expanding, absorbing, or hostile. The serious trader records the environment, because the environment is what gives his actions meaning. You want to know what the market is rewarding. That is one of the most practical questions a trader can ask. Is it rewarding early participation, or punishing it? Is it rewarding patience near extremes, or is it moving away before waiting traders can act? Is it rewarding continuation, or is continuation failing after the first push? When you track this daily, you stop treating every signal as equal. You begin to see which behaviors are currently being paid. There is discipline in this because the habit removes drama from recognition. A trader without records often discovers phase change through frustration. A trader with records can see it through evidence. He notices that range size has contracted. He notices that the best moves are happening early and then fading. He notices that breakout attempts are no longer holding beyond the first reaction. He notices that trades matching his preferred condition have become fewer. This does not require excitement, it requires attention. The record should be plain. What phase appeared to dominate the session? What did price do after reaching important areas? Did strong candles receive follow-through? Did weak moves continue lower, or get absorbed? Were clean opportunities present, or was movement tangled and hesitant? Did your type of setup behave well, or did it struggle? You are not writing a novel. You are building a reference. Over time, this reference becomes valuable because it protects you from treating today as a mystery. You begin each session with context. You know what has been changing. You know whether the market has been generous or difficult for your method. You know whether recent movement has been expanding, compressing, reversing, or trapping. That knowledge does not remove risk, but it reduces blindness. The cause and effect is direct. When you track conditions, you recognize changes earlier. When you recognize changes earlier, you reduce unnecessary trades. When unnecessary trades are reduced, your attention remains sharper for conditions that actually matter. The habit does not make you smarter than the market. It makes you less careless in front of it. This is the quiet difference between a trader who reacts and a trader who prepares. The prepared trader does not need to feel certain. He has a working description of the market before the pressure begins. He is not asking the next candle to explain everything. He already knows what behavior has been present, what has been changing, and what would confirm that the current phase still deserves trust. A trade is not finished when the entry is correct. It is finished only after you manage it according to the market that is actually unfolding. This is where a trader can be right and still leave with the wrong result. He enters well, reads the condition reasonably, and then manages the position as if every phase should pay in the same manner. He takes quick profit in a market that is beginning to travel, or he holds for distance in a market that is only rotating. The mistake is not always in the idea. Often, the mistake is in asking the trade to behave beyond what the phase is offering. Trade management is the conversation after entry. Price begins to answer. It either confirms the purpose of the trade, weakens it, delays it, or denies it. A trader who manages well listens to that answer. A trader who manages poorly keeps applying the same exit habit regardless of what the market is saying. He may have a rule, but if the rule ignores the phase, it can become a polished form of blindness. In a directional phase, the market rewards room. The best trades may not give many second chances. They may pause, shake lightly, and continue. If you manage those trades with a nervous hand, you turn a strong environment into a series of small gains. That feels safe in the moment, but the cost appears over time. You keep removing the very trades that are meant to pay for the losses. In that phase, cutting winners too quickly is not caution. It is failure to let the condition work.